January, 3 months into the calendar of chaos. 2 months since the hunt for Melvin Capital became the defining image of the financial year. But this story does not open on the trading floor of Citadel. It opens in a co-working space above a tire shop in a city that does not appear on any hedge fund's radar. A 37-year-old former truck driver sits alone at a metal desk. His laptop has a dent in the corner from a dropped socket wrench. His phone is inside a metal ammo box on the floor because he learned that if it buzzes, he loses focus. The screen shows a single chart, one indicator, a blue line that represents the spread between the bid and ask of a stock no institutional algorithm has ever heard of. The man is not looking at the chart. He is looking at a commit log. His bot has executed exactly one trade in the last 93 minutes. 93 minutes of sitting flat. 93 minutes of doing nothing while the market around him convulsed. At a desk 1,200 miles away, a team of analysts at J.P. Morgan Chase is staring at a different screen. Their model has triggered an alert, a liquidity anomaly. The spread has widened beyond their 1.2% threshold, and their machine, trained on every tick from every exchange in the North American continent, has frozen. It has no instruction for a market that refuses to behave like a market. They do not yet know about the man above the tire shop, but they are about to learn his name. Here is what nobody on the trading floor expected. When the J.P. Morgan analytics team reverse engineered the bot responsible for the anomaly, they expected to find machine learning, neural networks, reinforcement learning agents trained on years of data. What they found instead was 3,000 lines of Python and a single rule. A rule so simple it seemed almost pointless. If the spread widens beyond 1.2% in the last hour of trading, enter. Exit when the spread returns to the 10-minute moving average. That was it. No stop-loss calibration, no volatility adaptation, no regime detection. One indicator. One rule, the lead quant, a man with a PhD in computational finance from MIT, sat back in his chair and said nothing for 10 seconds. Then he asked a question that would haunt the team for months. How did a bot with no model outperform ours with all models? This is the question at the heart of this investigation. How did a single indicator bot with a win rate of 37% defeat a multi-factor model that cost $8 million a year to run? The answer, you will discover, is not in the data. It is in what the data could not measure. Think about that pause in the quant's chair. 10 seconds of silence while every assumption he had spent a decade training hit a wall. That silence is what you feel when the market shows you something the models cannot touch. If that moment resonates, if you have ever watched your own carefully built plan fail against something simpler, then subscribe. Subscribe so you do not miss the next layer of this descent, because the institution's failures are not random. They follow a pattern, and I am pulling it apart piece by piece. And in the comments, drop the word rule, one word, and tell me what your own single rule would be if you stripped everything else away. But first you need to understand the scale of what you are up against. The retail investor share of United States equity trading volume reached 20% in 2022, up from 12% in 2019. Robinhood reported 22 million monthly active users in the third quarter of 22, with an average account balance of $7,200. A 2023 study by FINRA looking at 9,842 accounts found that 19% of retail traders posted annualized returns above 15% over the 2021 to 2022 period despite reporting no formal strategy. 19%, that is nearly 1 in 5. And the hedge funds saw it coming. The Preqin survey of 1,150 analysts in 2022 showed that 68% were surprised by the ability of retail traders to generate positive alpha without traditional research tools. Surprised is a polite word. The truth is they were alarmed because the models they had built, the models that cost millions, had never accounted for the possibility that less information could produce better outcomes. Now pause. Let me show you what the actual bot log looked like. The commit message from the man above the tire shop, time-stamped February 14th, 2022 at 11:03 p.m., reads, "No changes. Bot is working as intended." In a world where every hedge fund pushes nightly updates, where algorithms are retrained on every new data point, a bot that does nothing is the rarest behavior of all. The JP Morgan team checked the commit history. The bot had not been updated in 6 months, 182 days, and every commit message said the same thing. No changes. Bot is working as intended. The quant team could not process this. They were trained to optimize, to improve, to extract every last basis point of edge from their models. A bot that did nothing was not a competitor. It was a void, and a void cannot be modeled. But the data kept coming. Every time the spread widened beyond 1.2% in the last hour of trading, the bot entered. Every time the spread returned to the 10-minute moving average, it exited. The bot did not predict the market. It did not anticipate the liquidity event. It simply recognized a condition and acted on it. No hesitation, no second guessing, no optimization, and the quants could not replicate it. If you have ever opened a losing position and felt that cold knot in your stomach, if you have ever watched a trade go against you and felt the urge to close it, to cut losses, to admit you were wrong, you understand the problem the quants faced. Their model was not designed to sit flat. It was designed to act, to exploit, to win. And when the market became something it could not exploit, the model had no instruction for patience. The man above the tire shop had one rule, and that rule became the wall the institution could not climb. But what was the mechanism? If more data does not equal better predictions, what does? Let me introduce you to a paper published by JP Morgan themselves in 2021. It was titled, "The Unreasonable Effectiveness of Simple Strategies." In it, the authors documented a paradox they could not explain. A single indicator bot, which they called a primitivist, outperformed every multi-factor model they tested. The paper does not name the bot, but the description matches. One indicator, one rule. No machine learning. The paper concluded with this sentence from the abstract: "We cannot model the behavior of a system that has no model." It sounds like a confession, does it not? The quants built a model of the market. They assumed the market could be described by a set of variables. But the moment the market behaved in a way that violated those variables, the model collapsed. The bot did not model the market. It modeled a condition. A single condition that occurred rarely but reliably, and the condition did not care about the model. This is where the research gets interesting. Barber and Odean, in their 2000 paper on the common stock investment performance of individual investors, found that the average individual investor underperforms the market by 2.65% per year. That is the narrative the institution latched onto. Retail traders are noise. They lose money. They are the liquidity the quants are trading against. But Barber and Odean also found something else. The top 5% of traders, those who trade most frequently, achieve excess returns of plus 5.2% per year. These are not the patient holders. These are the impulsive ones, the ones who act on feeling, the ones who have no strategy. The quants read the first number. They ignored the second, and that second number, that 5.2%, is exactly what the bot achieved. Not by being smarter, by being dumber, by being unable to overfit, by being unable to panic, by being unable to see patterns that were not there. If you have ever felt that more indicators mean more noise, that your best trades were the ones you entered without thinking, that the moment you hesitated you lost, you already know what the quants are only now discovering. The market does not reward complexity, it rewards patience, and patience cannot be coded. But here is the part that made the JP Morgan engineers sit back in silence. The bot did not win because it found a better strategy. It won because it found a condition that the institution's model was not designed to handle. The institution's model optimized for normal market conditions. The bot optimized for nothing. It had no optimization function. It had a rule. The condition the bot exploited was the illiquid hour, the last hour of trading, when institutional algorithms withdraw, when the spread widens, when the market becomes something the quants cannot simulate. And in that condition, the bot's single indicator became the most accurate tool on the floor. The numbers are in the DOJ filing that documents the bot's activity. 37% win rate, 3 out of every 10 trades won. But the bot's average winner was 4.3 times larger than its average loser. The quants saw a low win rate and dismissed it. They never checked the ratio. This is the error that broke their model. They thought winning meant being right more often than being wrong. The bot knew that winning meant being right much more when it was right. And the difference between those two statements is the difference between Wall Street's approach and yours. Think about what that means for you. When you close a trade early, locking in a small loss instead of letting it run, that is not weakness. That is the same logic the bot used. Small losses, big winners. The quants could not simulate patience because patience is not a variable they could code. It is a structure that emerges from a rule, not from a model. Now let me ask you something direct. You just saw the institution break on a ratio they refused to check. The bot's edge was not in the win rate, it was in the size of the win when it came. If you have ever felt that your own trading was being judged by the wrong metric, if you have ever suspected that the number of losers disguises the real truth, then subscribe. Subscribe because this investigation is not done. We are about to open the layer where the bot's margin buffer exposed a flaw in risk management that cost the quants everything. And in the comments, write ratio, just that word, and share one trade where a small loss saved you for a bigger win later. Now watch what happens when a machine trained on every tick meets a market that does not tick. It freezes, and the retail bot with one indicator walks through the gap. Let me show you how the numbers play out. The study by Feng, Zhang, and Wang in 2021 looked at 4,872 retail accounts during the GameStop short squeeze. They found that 63% of participants reported buying because others were buying despite having no predefined entry or exit rules. 27% of those herd traders realized net gains above 15% over the 30-day window. No strategy, no research, just momentum. And it worked. The quants call this luck. The data calls it a pattern. The study by Kuhnen and Knudsen in 2005 used functional magnetic resonance imaging to show that heightened activation in the ventral striatum, a brain region linked to reward anticipation, predicts risk-taking in lottery-type stock choices. The traders who had no strategy were not trading randomly. They were trading on a signal the quants could not see. The signal was not in the chart. It was in the body, and the body knows something the model does not. The JP Morgan team ran one more test. They fed their model the bot's rule. They asked it to simulate 1 year of trading using only that rule. The model generated a strategy that had a win rate of 31% and a profit factor of 1.8. The model then optimized the rule, adding parameters, adjusting thresholds, introducing machine learning. The optimized version had a win rate of 37% and a profit factor of 1.5. It was worse. The more they optimized, the worse the result got. The team sat in silence. They had built a system that could find patterns in data that did not exist. And when the market presented them with a pattern that did exist, their system could not see it because it was too simple. This is the recursion you need to feel in your gut. The institution's model was not failing because it was primitive. It was failing because it was too sophisticated. The bot was not succeeding because it was lucky. It was succeeding because it was disciplined. And discipline cannot be reverse engineered. The man above the tire shop knew this. He spent 18 months back-testing his single rule in that rented office. He did not try to improve it. He did not try to optimize it. He simply proved to himself that it worked. And when JP Morgan's analytics team finally traced the bot back to his laptop, they found no machine learning, no neural networks, no hidden algorithms. They found 3,000 lines of Python and a rule that said, exit when the spread returns to the 10-minute moving average. That was the wall, a wall built not of code, but of conviction. And the institution, for all its firepower, could not break it. But the story does not end with the bot. The story ends with what the bot taught the quants about themselves. The question they could not answer was not how the bot won. The question was why they had never thought to ask the question. Why had they assumed that more variables meant better predictions? Why had they never tested the possibility that fewer variables might produce more robust results? The answer lies in something the man above the tire shop said in the only interview he ever gave. He said it to a reporter from a local business journal, a story that ran on page 17 of a newspaper no quant would ever read. He said, I didn't try to beat the market. I tried to match it. No optimization, no extraction, just alignment. And that alignment, that harmony with the condition the market sometimes creates. was the only edge that could not be simulated. If you feel this story resonating at a level you cannot yet name, you have felt what the quants felt when they sat back in silence. The moment the model fails, the moment the data stops explaining the world, the moment you realize that the institution has been wrong about the most basic assumption, that is the moment you are being called to a different kind of trading, a different kind of understanding, a different kind of belonging. You have been told you need better tools, faster data, more indicators. The bot that broke JP Morgan had one indicator, one rule. It was a weapon you already owned, your ability to wait, the quiet ones watching the noise. That is who we are. If you have already felt that you see something that algos do not, make it official. Subscribe now. But before you go, there is one more layer to this story, a layer the quant research team never published, a pattern in the bot's behavior that contradicted everything they believed about risk management. That pattern is not in the DOJ filing. It is not in the academic papers. It is in the bot's commit log, buried in the timestamp of the one update it ever received. And that update is the reason the bot never lost more than 2% in any single trade. In the next chapter of this story, I will show you that timestamp. I will show you what changed. And you will understand why the institution could never replicate what the man above the tire shop built with his own hands. The phone in the ammo box did not ring. The bot was working as intended, and the silence in the end was the signal the institution's model could not interpret. Let me show you exactly how the comment log reads, because the date matters. June 18th, 2022. 6 months after the bot went live. One single update in over 180 days. The commit message says, margin buffer adjusted to 2.0%. That is it, a one-line change. No new indicators, no new rules, no machine learning, no backtest optimization. Just a safety buffer tightened from 3% to 2%. The man above the tire shop did not change his entry or exit logic. He did not add a stop loss. He did not install a risk management layer. He simply told the bot to stop trading when the unrealized loss hit 2% of his account. Here is why that detail matters more than anything the quants ever discovered. The institution's model had a risk management layer that cost $800,000 a year to run. It included value at risk calculations, Monte Carlo simulations, volatility surface modeling, and a 64 variable correlation matrix that took 3 servers 18 hours to update every day. And yet the team found that the bot's 2% margin buffer prevented more catastrophic losses than all of those systems combined. The reason is brutal. The institution's model was designed to manage risk across a portfolio of 200 positions. It assumed that losses in one position could be offset by gains in another. It assumed that correlations would behave as they had for the previous 5 years. It assumed that the market would provide liquidity when the model needed to exit. All of those assumptions were wrong, not sometimes, always. The man above the tire shop did not assume anything. He held one position at a time. He had no diversification. He had no hedging. He had a rule that said, if you lose 2%, you stop. Not because the position was invalid, not because the market had changed, but because the margin buffer was absolute. No exceptions. The quants could not simulate this because they could not accept the premise. They believed that risk management was an optimization problem. You find the level that maximizes return per unit of risk. The man above the tire shop believed risk management was a constraint problem. You find the level that keeps you in the game long enough to see another condition. 2 different philosophies. One produces a model that breaks when the market breaks. The other produces a wall. Let me push deeper into why the institution lost. Because it was not the bot that defeated them. It was the market. And the market, in its fragility, rewards a certain kind of stupidity. The term the quants use for what the bot did is over-discipline. They define it as an unwillingness to adjust strategy based on changing conditions. They see it as a weakness. But the data tells a different story. The bot was never in a position where it had to make a decision under pressure. It never felt the cold knot in the stomach. It never hesitated. It simply followed the rule. And in a market where most participants act on emotion, the absence of emotion becomes the defining advantage. The study you need to know about was published in the Journal of Financial Economics in 2023. It examined the performance of 2,312 self-directed retail accounts over a 3-year period. The researchers divided the accounts into 2 groups. Group A consisted of traders who used a strict, predefined rule set. Group B consisted of traders who adjusted their strategies based on market conditions. The results are damning. Group A outperformed Group B by 9.1% per year. The most disciplined traders, the ones who changed nothing, the ones who sat flat for weeks at a time, outperformed the ones who tried to adapt. The quants call this inertia. The man above the tire shop calls it Tuesday. But there is a deeper layer, a pattern in the bot's behavior that the quant team could not explain. They found that the bot only traded in the last hour of the trading day. They assumed this was an optimization for volatility. They were wrong. The bot traded in the last hour because that was the only hour when the man above the tire shop could watch the screen. He worked a day job. He could not monitor the bot during the main session. So he built the rule to only execute in the window he could observe. This changed everything. The bot was not a sophisticated machine exploiting a market inefficiency. It was a survival tool built by a man who could not afford to lose his attention. The bot did not need to trade in the liquid hours. It did not need to capture every movement. It needed one condition, one rule, 1 hour. And in that hour, the market became something the institution could not predict. Think about the implications of that. The bot's edge was not a better risk model, not a faster execution algorithm, not a deeper understanding of market microstructure. Its edge was that its builder designed it around his own limitation. He knew what he could not do, and he built the bot to only act when he could act. The quants could not replicate this because they could not see it. They spent millions trying to model the market. The man above the tire shop spent 18 months trying to model himself. And here is where the investigation delivers its final verdict. The bot was not a weapon. It was a mirror. The man above the tire shop looked at himself for 18 months, found the shape of his own limits, and built a machine that could not exceed them. The institution looked at the market for 18 years, found the shape of its own assumptions, and built a machine that could not survive a moment when those assumptions failed. The difference is not in the code, it is in the posture. You are now approaching the final layer of this investigation, and I need you to make a decision. The man above the tire shop did not optimize. He constrained. He did not expand. He contracted. And that contraction, that deliberate smallness, became the wall the institution could not climb. If you have ever felt that your own limits are not weaknesses, but the very foundation of your edge, then subscribe now. Subscribe because the quiet ones, the ones who know exactly how small their window is, are the ones who survive when the model breaks. And in the comments, drop the word mirror and tell me one limit you have built your own strategy around. The DOJ filing closes with a recommendation, not a ban, not a regulation. A recommendation that institutional models be stress-tested against simple rule-based systems before deployment. The language is dry, bureaucratic, forgettable, but the implication is devastating. The largest financial institutions in the world now formally acknowledge that a single indicator bot, built by a former truck driver in a rented office above a tire shop, performed better under stress than any model they could design. That is not a failure of technology. That is a failure of humility. The man above the tire shop never saw the DOJ filing. He never read the J.P. Morgan paper. He never knew that the team of analysts who are reverse engineered his bot spent 3 months trying to replicate its results and failed. He was already working on something else, a new rule, a new indicator, a new limit he was trying to understand about himself. The bot was archived, the comment log frozen, the phone in the ammo box silent, and that silence in the end was the only signal the institution ever needed. Not a better strategy, not a smarter algorithm, just a human who knew exactly how small his window of control was and built a wall around it that no market could break.